volatility reigns supreme in the chip industry. Geopolitical tensions in the Asia-Pacific region, where much of the chip manufacturing occurs, continues as America and China impose restrictions on one another. Excess supply continues to be wrung out of the supply chain as we're seeing factory underutilization and lower new bookings from chip customers. And the new generation of chips, mainly AI tier technology, requires massive upfront capital investment to manufacture the future. All of this hurts the bottom line for investors and makes them look elsewhere to put their capital. And even the ever-reliable Applied Materials is not immune from this investor uncertainty. Welcome to the Quality Investor. Applied Materials, ticker AMAT, has experienced a slowing of growth for their fiscal year 2024, which just ended at the end of October. But that is the nature of this cyclical industry. Every 3 to 4 years, we enter the trough of the cycle where demand dries up and excess capacity is squeezed out. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. It typically comes when massive cash flows earned at the peak of the cycle are reinvested back into the business for future expansion. That growth slowdown and huge capital expenditure make it appear that the party is over for these businesses. Of course, with any cycle, things turn around for the better and usually growth comes back even stronger than before. And I don't see any reason to believe this time is different. In fact, some geopolitical maneuvering could make this next growth cycle even more incredible. There has been a concerted effort by the United States to exclude China from its most sensitive technology in the semiconductor industry, which I have posited before is one of the most vital industries to U.S. economic supremacy. The CHIPS Act, enacted back in 2022, the aim of the legislation was to bring chip manufacturing back to the United States, as well as cutting China out of the supply chain. But Applied Materials has not been the beneficiary of this legislation. They did not receive any grant money from the act and are actually under investigation by the government for sales of equipment to China without an export license. This has caused a bit of a roller coaster ride in the stock market for Applied Materials. They had a nice run up to over 250 in July before the negative news about further investigations and lack of CHIPS Act funding sent the stock back down to where it is today, hovering in the mid 180s. Despite this, the stock is still up over 13% year to date. Now, with earnings released post-market on Thursday, can Applied Materials gain some momentum to close the year out strong? They beat on the top and bottom line after all, so let's dive into it. Right off the bat, things are not looking good for Applied Materials. They closed on Thursday at $186, but pre-market, they're already down almost 8%. This is despite a pretty strong earnings report. The major reason for this is they offered mixed guidance. The midpoint of their guidance came in a little bit below what Wall Street was expecting. So that means this potential sell-off today could be a good opportunity to buy back into this very strong company. Quarterly revenue was $7.05 billion, up 5% year over year. That may not seem like a strong year-over-year growth number, but keep in mind two things. The first is that Wall Street was expecting them to come in a little under $7 billion for this quarter. And secondly, they started out their fiscal year 2024 with negative to flat growth year over year. So with Q3 and now Q4 having 5% year over year gains, we're seeing that growth pick up a little bit. And you can see that here in the annual revenue of $27.18 billion. That is actually up 2% year over year. A lot of chip companies have seen revenues decline year over year for their fiscal year 2024, including a couple of my holdings, Texas Instruments and Microchip Technology. So posting a revenue gain in this very troubling macro environment, in my view, is a pretty good sign. But it's not all good news here. On the year, margins are essentially flat, just about 80 basis points higher on the total year-over-year number, but completely flat for the operating margin. And while earnings per share is up 6% on the total year-over-year number here, we are down 12% on the quarter year-over-year. On the earnings call, they attributed this lack of margin expansion and decline in earnings per share to China's revenue contribution declining to 30% in Q4. They say it's reflecting a normalization after elevated levels in previous quarter. The reason, however, seems to be more related to the CHIPS Act. Applied Materials and Lam Research shift supply chains away from China to meet new U.S. guidelines. The U.S. semiconductor industry is intensifying efforts to exclude Chinese firms from its supply chains following Washington's directives to reduce China's investment in critical next-generation technologies. Prominent chip makers such as Applied Materials and Lam Research have informed suppliers that they must find non-Chinese alternatives for specific components or risk losing their supplier status. Industry experts indicate that shifting to non-Chinese suppliers will likely increase chipmakers' costs as alternatives may be limited or more expensive. Applied Materials highlighted its efforts to source alternative components to ensure stable supply, especially as China remains one of its biggest markets. Further, recent Commerce Department rules require U.S. companies to obtain licenses before disclosing technical information to Chinese suppliers, limiting the scope of Chinese involvement in sensitive chip technology. Those export licenses, I believe, are one of the reasons Applied Materials is being investigated. U.S. government extends investigation into Applied Materials for alleged China sanction breach. The U.S. government has extended its investigation into Applied Materials for allegedly facilitating the shipment of chip manufacturing tools to China without an export license. So it's possible, in the short term, we could see these margins continue to squeeze or remain flat while Applied Materials sorts out this supply chain issue. Despite that, Applied expects net revenue to be approximately $7.15 billion in the first quarter of fiscal year 2025. This is actually a little bit lower than what Wall Street was expecting. Wall Street was expecting somewhere on the high end of Applied's guidance. So take this 7.15, add that 400 million. Wall Street is expecting somewhere in the range of 7.5 billion. And I think that's the reason we saw the drop today. It's not actually these China supply issues. And I believe that because the news about the investigation came out late last year and the market largely shrugged it off until about July when we saw Applied Materials price fall, but that was more due to not getting any grant money for the CHIPS Act. Despite the weakness we're seeing and the issues with China, the semiconductor systems segment actually posted a 1% gain year over year. Applied Global Services again posted a strong 8.6 year-over-year gain. And even Display, a business they've been slowly moving away from, posted a 2% gain year over year. And that was despite what they said on the earnings call of ongoing weakness in the end market demand for displays. Another reason I believe the supply chain issues Applied Materials is facing in the short term, is only short term, is that they're a key supplier for NVIDIA's chip manufacturing process. Applied Materials foundries are crucial for NVIDIA's AI chip production. So with such a key customer in NVIDIA, it's reasonable that these two businesses will sort out any supply chain issues in the medium to long term. One more positive note, Applied Materials had $2.575 billion in operating cash this past quarter. And with only $407 million in capital expenditures, this results in $2.168 billion in free cash flow. This is up year over year by 74%. And it's up sequentially by almost 4%. While free cash flow was suppressed in the beginning of the fiscal year 2024, it's back on an upward trajectory. So looking forward, analysts are actually projecting about a 10.67% growth rate in the next fiscal year, with revenues coming in at just over $30 billion. So with the past 2 years of being relatively flat to slightly up growth at 1% and 2%, we're now entering the growth cycle again for the chips industry. Ultimately, the next 10 years, I expect about 6.6% growth in that time frame. So coming into what my expected growth rates are in general here, we can see I'm estimating about a 33% operating margin by year 10 and a free cash flow margin of 27.35%. Keep in mind, the last 2 quarters, the free cash flow margin was at 30%. And you can see here, they in fact closed out the previous fiscal year at 27.5% free cash flow margin. So I'm expecting the free cash flow margin to remain relatively flat going forward. Like I said, the revenue growth at about 6.6%, operating income growing at about 8%, net income 7%, earnings per share almost 10%, and free cash flow growing at 6.1% per year. All of this is much slower than what their 10-year CAGRs are for each of these categories. So these relatively conservative projections are actually giving us a discounted cash flow price of $240.22 for Applied Materials. Applied Materials is also a very strong dividend payer. They have a very low free cash flow payout ratio at 17.2%, and I expect a nice increase in their dividend in this next fiscal year. Their current dividend is at $1.44 for the fiscal year 2024, but with a 15% increase on the quarterly dividend of 40 cents to 46 cents, that would bring our fiscal year 2025 dividend to $1.72. Projecting out about 14.5% year-over-year growth over the next 5 years, we can see that's a pretty reasonable growth projection, given that by year 5, if they continue growing their free cash flow at just about 6% per year, they're only going to have a free cash flow payout ratio of 22.5%. And with a perpetual dividend growth rate at 7.125%, that's a dividend discount price of $237.06. So where does our valuation stand on Applied Materials after a pretty strong earnings report yesterday? Well, they closed out at $186. That might come down a bit today, given the negative sentiment around their guidance, but I had a discounted cash flow price for my bear case at $199.42. That's based on a free cash flow margin of 25.5%. On a base case, $240.22. And like I showed before, a 27.35 free cash flow margin. Now my bull case, $290.57. That's with a 29.3% free cash flow margin, an operating margin of 34%, and revenue growth over the next 10 years at about 8.2%. The dividend discount, my bear case is at $197.83. Like I showed you, $237.06 for the base case, and $289.88 on the bull case. I'm actually astonished at how in line the DCF model and the dividend discount models are on their prices here. And the exit multiple comes in at $249.40. My comps on the exit multiple are KLA, Lam Research, and Teradyne. And collectively, they have an average PE of 29. So based on these figures, there's still a lot of upside here, in my view, for Applied Materials. And with what we expect to see today, the drawdown in that price, there might be even better buy opportunities. So with no margin of safety, I have a buy price of $243.77. With a 20% margin of safety, which is what I typically go for when I buy Applied Materials, it's $195.02. After today, Applied Materials could very well be trading in the 170s. That's a forward PE of 21.4, slightly above what their forward PE is expected to be at 20.4. You can see their PE ratios, they are a bit expensive relative to historical averages. However, management has done a very good job of investing the capital Applied Materials has. Their trailing 12 ROIC is at 30%, right in line with what their 5-year average is. And you can see that ROIC has been growing over the last 10 years because it's well above the 10-year average at 24%. And with strong growth expected to come back into the semiconductor industry over the next couple of years, as we come out of this trough in the cycle, the margins should only improve for Applied Materials. So I think this is a very strong company in the long term. I do think there's going to be some short-term struggles given the supply chain constraints and reducing the reliance on China for revenue. But I have no doubt that they will figure out how to navigate around those constraints and set themselves up for a strong future. So I've been waiting for Applied Materials to come back down to a pretty reasonable price. And I definitely think I'm going to start buying again, as this is a position I want to increase in my portfolio. I was never comfortable buying over $200. And even in the 180s, I always thought it was slightly too high. But remember the old Warren Buffett adage, when the market is fearful, it's time to be greedy. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.